Is the death cross signal actually any good, and can it help us when trading popular commodity markets? Hello, I'm David Jones from Capital.com, and I thought we'd do just a brief video on trading strategy. There's a lot of talk about a death cross signal when it comes to a whole host of different markets. You know, my background is as a technical analyst in financial markets for the last 25 years. I'm familiar with this, although there is some disagreement as to whether it's when two moving averages, a longer term and a shorter term, simply cross over, giving a sell signal, or whether they both have to be falling at the same time. I don't think it makes a whole world of difference if we're going to be practical about it. So what we're going to do in this video is we're going to have a look at the idea of this death cross, this sell signal. I'm also going to look at some buy signals as well, and we're going to apply it to three popular commodity markets: gold, natural gas and crude oil, to see if this can actually help our trading. As usual, if you're watching this and you haven't subscribed, if you click on subscribe, support the channel, and we'll continue to push out varied content like this. But let's get into it. Let's take a look at the death cross in a bit more detail, see what all the fuss is about. Can it help us, or is it actually a load of rubbish? So let's take a look at this idea of using moving averages. This is the gold price. So the blue, that's a 50-day moving average. The green one is the 200-day, so shorter term and longer term. At the moment, the 50 is coming in around about 1504. So what that means is the average price for the last 50 days closing prices of gold is just over $1,500 an ounce. If we take a look at the green, the 200, that's coming in about what, 1390. So again, if we took the last 200 days closing prices, averaged them out, it'd be 1390. So let's look at this idea of crossovers. So if we go back to June 2018, you can see the price of gold had been falling for what, a couple of months. And of course that meant the average price was getting lower. The 50-day was falling here and crosses through the 200-day moving average. So there's our cross, whether we call it a death cross or a crossover, whatever it is. The 50 falling below the 200 is a negative sign. And that was when the price was trading around about $1,300 an ounce. And you can see over the next couple of months, it dropped down and traded to $1,160 in August. Here's another example here, 2016, December 2016, the crossover occurs actually late November 2016. So the crossover, the moving averages are here, but don't forget the price is actually down here. So around about 1190. The price did push a little bit lower, but it wasn't a massive sell-off. It looks like the bulk of the move had already happened. And over the next few months, the price moved a lot higher. So there's an example where we did see the price push a little bit lower, but it was by no means a major sell signal suggesting a crash. And the last example on gold, we'll go back to, we're back in 2013 now. So again, the blue, the 50s falling through the 200. The price was around about what, 1581. Over the course of the next 5 months, the price of gold dropped almost $400 down to $1,200. So an example there where it did work pretty well. And just as a reminder, this is where we are now. You know, we're a long way away, at the moment at least, from the 50, from the 200. We'd need to see much lower prices to drag these two back together. So we're nowhere near a cross at the moment. The last signal was actually a buy signal back here, late December, when the 50 moved above the 200, when the price was $12.80. Let's take a look at another market. So this is natural gas. Let's start from over here. So same as before, the 50 is the blue, the green is the 200. Let's have a look at July 2014. Here's the cross of the two. The price was trading around about 4 at the time. It did blip up. It rose about 20% after, but eventually it did sell off and more than halved. You know, this is a move that played out over almost a couple of years, but we did see the price trade off after that initial blip back towards below 2. Let's have a look at the next signal after. Actually, there are some good examples in here because to show it doesn't work all the time, and actually the drawback of using moving averages, if we've got a market that is trading sideways, you get some real choppy signals. So here we go, sell signal in there, March 2017, wasn't particularly good, was rubbish actually. Buy signal there in May, that was useless as well, right at the top. Sell signal there, the market does drift a little bit lower, but you can see when you've got choppy sideways markets, moving averages are no good, in a whole period there from what, most of 2017 through to the summer of 2018, where these two moving averages generated very poor signals. So June 2018, the 50 moves above the 200. That's our buy signal. And the market goes sideways again, but then of course we had that explosive move in natural gas up towards nearly 5 in November 2018. So it caught that move eventually, but it given the buy signal about 5 months before that. And because the reversal was so sharp off those highs, the sell signal didn't come in till here. And the market was trading, this is February 2019, the market was trading around about 2.7. So it had almost halved from those highs before the sell signal kicked in. And this is another issue with moving averages. They are a lagging indicator. The market needs to move before they'll flip in the opposite direction. And to bring things right up to date, this is where we are in natural gas now. We are almost, if we had a bit more strength in the natural gas price, on the verge of the 50 flipping over with the 200 and giving us a buy signal. We'll see what the next few days bring. Let's take a look at one more market. Okay, let's take a look at crude oil. I'm going to start with a buy signal here actually, because we had this big run from 2017. So buy signal comes in here, October. The market is trading around about $52, $53 a barrel. Then of course we have that massive run up to 75. So here's an example where the buy signal worked really well. But in terms of the sell signal, if we're going to call it a death cross, we don't get it until here, until November 2018. And we're not selling up here, of course, because the market is down here. The market's trading at 57. So it's already dropped back $20. It did move again, another, $12, $13 lower. But there again, there's the lag. So it did signal more weakness to come. But a chunk of the move had already happened. And if we were following that to get out, we wouldn't have reversed our position until right over here, April 2019, when the price was trading at 64. And because we've had fairly sideways trading in crude oil over the last few months, again, we've got some fairly messy signals in here at the moment. The 50 is below the 200-day. The last signal we had was a sell signal. The market's trading sideways. If it carries on like this, chances are we'll get a flip the other way. So a couple of okay instances for oil, but I think a great example of highlighting the drawbacks of moving average. They lag behind the market, and also if the market's going sideways, you're getting lots of false signals. So there we go. I'm still a bit skeptical. I think you would notice, a change in the trend without having to worry too much about a 200-day and a 50-day moving average. But there are lots of different profitable trading strategies out there. So maybe this approach will work for you. We'll wrap things up there. So from me, David Jones and Capital.com, good luck with your trading.